The TRREB market stats are in, and TRREB has given us a good idea of what took place during the end of 2024. The December market stats show interesting information regarding buyer activity and seller activity. My name is Nico James-Bock. I am a broker at Royal LePage Signature in downtown Toronto. We'll take a deep dive into the December 2024 stats, and I will leave you with important takeaways, which will give you a clear picture of what has happened and where we go from here going into the spring market. I want to cut through all of the noise that is going on at the present moment and highlight information that the media is choosing not to share with the public. If we start with GTA, the market stats show, I'm just going to go quickly over the macro market stats. The GTA market stats show 4.58 months of inventory. That simply means that if no new products came to the market, no new listings, we would run out of inventory in about 5 months. This figure is reminiscent of what has taken place over the end towards the last quarter of 2024. High inventory levels, particularly in the condo sector, is seen in most of the regions. The average sale price is currently sitting at 1,117,000. And that's a slight dip over the year-to-date figure for 2023. So that is typical. We are in the slowest month of the real estate market year, December, followed by summer, which typically is also relatively slow. So these figures are in keeping with what normally happens in the marketplace. Keep in mind that there are other factors involved that affect the sale price. Most noticeably would be the political situation that's currently taking place, both locally here or regionally here in Canada, and also south of the border. There will be a new president that will take his place in the White House on January the 20th. And our prime minister has issues with his own government with a declaration that he will be stepping down from the Liberal Party and not seeking re-election at the upcoming federal elections. Going to take an overview look of pricing from September 2020 to December 2024. This gives a clearer picture of how prices fluctuate. This overlay is with the Bank of Canada's interest rate announcements that took place over that same time period. So you can see if you are listening to this podcast, then you can check out the stats that I will release shortly on the various social channels. If, however, you are following this podcast with its video, then you can follow along and look at the charts with me. In the end of 2024, we're seeing that prices are dipping. Again, that is in keeping with the various factors that took place over the September, October, November, and December months. So you will see that the trend line will start to trend upwards as we go into the spring market. Passing on to the Toronto market stats, we saw in the GTA the average sale price being 1,117,000. In Toronto, that sale price is 1,107,000. So Toronto is one of the biggest regions. and it is more or less in line with the average GTA. 26 days on market and 5.31 months of inventory, so slightly more. There is more condo product in the Toronto area, and that's contributing to the slightly higher days, months of inventory figure that we're seeing for Toronto. Toronto saw 24,599 sales year to date as of December 2024, which is a slight increase over the year to date of 2023. Moving on to one of the most expensive markets, being Oakville, we see the average sale price at 1,519,489, with 27 days on market and 4.84 months of inventory. So, in keeping with the 5 months of inventory, Oakville also has a high number of condominiums and projects. And also a large number of resale properties that are sitting on the market, in part because of the higher than average resale price. If we go to the other end of the spectrum, Durham region is the only region that is showing a average sale price of below $1 million. So clearly there are um, uh, properties, both resale, freehold, and resale condominiums that are priced above that figure. But there are also a number of properties that are a little bit below, reaching an average sale price of still just below $1 million. I suspect that as we move into the spring market, uh, we will see finally in Durham region that breaks the $1 million mark ceiling. I say this because in Durham region has one of the lowest months of inventory figure at 3.07 months. So if nothing new came to market in Durham region, they would run out of inventory in just a smidge over 3 months. That calls for very tight conditions. So by tight conditions, I mean that pricing is more volatile. Heading upwards, there's less, I guess, softness in the pricing of Durham properties. They're holding fairly firm at the just below the $1 million mark as an average price, and properties are moving fairly quickly. The average days on market in Durham region is 20, so it also is reflecting probably possibly the lowest days on market of all the regions. Moving on to Mississauga, another large region, it is closer in line to the average sale price in Toronto. So at 1,056,409 and 25 days of inventory and 4.95 months of inventory. So roughly the GTA average. The final region that we'll take a look at is York region. York region is also an expensive region at 1,311,026 as the average sale price. Slightly under Oakville's figure. 26 days on the market average, and 4.04 months of inventory, so slightly below. Uh, the figures are or the conditions are tightening up in York region. So what does all this mean for buyers, sellers, and renters? So just giving a big picture, the housing prices, the average home price in the GTA reached, as I mentioned, 1,117,600 in December. The city of Toronto saw a negative 0.9% decrease. pointing to a slight dip, which is usual for December. Other regions reflect similar stats as we've just seen. However, rising demand is an important consideration. Toronto remains still one of Canada's most sought after markets, driven by its status as a global financial hub and growing tech sector. So suburbs like Mississauga, as I just mentioned, Brampton also, and Durham region are seeing rising interest as buyers seek more affordable options. So there is more, tends to be more activity in those regions with respect to what's happening in Toronto. And Ontario's strong job market and immigration influx contributes to population growth, further boosting demand. Now, while some cooling has been seen due to high home prices, the overall demand remains robust. So people are getting more accustomed to the fact that prices aren't coming down. There is some wiggle room in some sectors, but generally speaking, prices are hedging upwards month over month, and that trend will continue, especially for entry level homes. So, entry level homes are those homes that are priced between 600 and 700,000, roughly. So, mostly condominiums. Those are the ones that are tending to attract most attention. Even though not all buyers are acting on them now, they will. They will in the coming months as we see further declines in the overnight lending rate. On that point, interest rate impact. Rates are expected to decrease into 2025, increasing buyer demand. Dr. Sherry Cooper, who is the lead economist at Dominion Lending Centers and a frequent contributor to our analysis of the market stats, along with Sean Hildebrand from Urbanation. Dr. Cooper said during one of our meetings that she expects the overnight lending rate to fall to 2.5% by the mid part of the summer 2025. So, what that means is there is still room for the Bank of Canada to reduce the overnight lending rate. The next announcement will be at the end of January, followed by another announcement in the beginning of March. I believe that both of those announcements will be interest rate reduction announcements. And I say that simply because we haven't seen a sharp increase in home prices as a result of the interest rate reduction announcements. There were five of them starting in June. On June 5th of 2024. So, had the bank seen a sharp increase in affordability in home prices, then they would have been less likely to drop the overnight lending rate as aggressively as they have, and less likely to continue those drops. So, as I mentioned, we are expecting two more drops, at least two more drops in the next two announcements. Expectations for buyers. So let's pass on to the buyer sector. Affordability challenges. While interest rates are expected to decline gradually, the impact of high housing prices in major regions like Toronto, York, and Halton will still be a challenge for many buyers. Hence, the fact that they will seek other opportunities in other regions. The new mortgage rules, however, that kicked in on December the 15th may help some buyers penetrate markets that before were unaccessible or inaccessible. So they will stay in some of those more expensive markets because of the most recent change in regulations. Opportunity in the suburbs. Suburban areas are projected to see more price stability and may be more attractive to especially first-time home buyers and those looking for better value for their money. Areas like Durham region, which is hovering around $1 million for now as an average sale price. Mississauga, Brampton, and Ottawa are seeing mixed price changes, making them viable alternatives to the high cost core regions. More inventory. Inventory is a huge factor. A growing number of homes available for sale could give buyers more choice, but competition may still exist in certain markets due to demand returning as rates ease. Expectation for sellers. So if we move on to the sellers, we are thinking about tight timing. So sellers in 2025 will likely benefit from a surge in demand in the spring and early summer months, driven by the stabilization or decline of interest rates. Realistic pricing. With the most markets with high inventory, so more than 4 months, in buyer friendly balanced conditions and expected to shift towards more balanced conditions, as in like 3 to 4 months, sellers still need to adjust expectations and price their homes carefully. Those listing too high might face significantly longer waiting periods, which means days on market. So we're now seeing on average 25 days, 25 to 30 days. In the condo market, that tends to be higher. But overall, 25 to 30 days is a realistic expectation for resale activity. We may see longer, or sellers may see longer days on market if they price too high. Stronger negotiation power in the suburbs. So, sellers in high demand, low inventory areas, especially in suburban regions, may still enjoy more favorable conditions and could see prices rise or remain stable. So we will pass on to the renters, the renting sector. Average condo rents in the GTHA for leases signed during the third quarter. We don't have figures yet for the fourth quarter. Decreased 3.8% year over year to 4.04 dollars per square foot. The average monthly cost of a condo rental leased in the third quarter fell 5.7% from a year ago to $2,762. That's for a one bedroom, with the average unit size decreasing to a record low 684 square feet. That's the average size of a condo rented in the GTHA. Despite the recent decline, average per square foot condo rents remained 4.7% higher than 2 years ago and have increased 17.4% over the past 5 years. I'll have the fourth quarter rental stats next month, so in February, towards the end of February. No figures are available for private single family home rentals like basement apartments and ground floor freehold homes. Condo rents experienced downward pressure due to a record high number of new condo deliveries. The number of condos that were registered, i.e., that were completed and reached final closing, so far this year, the third quarter, has totaled 23,473 units, a 132% increase over the same period in 2023, which saw 10,098 units, and a 67% increase over the 10-year average of 14,087 units for the same time period. There were a lot of condos that came to market in 2023 and 2024, leading to a high number of available units. Sean Hildebrand, as I mentioned before, is another contributor to our market stats. He's the president of Urbanation, and he says that the latest quarter, the third quarter of 2024, provided a good lesson that large increases in supply can bring down rents. However, this should be viewed as a temporary adjustment as completions for both condos and rentals will begin to fall dramatically in the coming years, given the latest trends for construction starts. So, as construction starts decrease, there will be fewer condominium units that come to market that will be available for rent. So, with demand set to continue trending higher into next year, so 2025 and 2026, the big variable to look out for is supply. While new listings have recently begun to taper off, a spike in mortgage renewals next year, or even 2025 and 2026, could cause more supply to arrive on the market. So we have to keep a close look on that as we head into the spring, summer, and fall months. Across the country, 1.2 million mortgages will come up for renewal, 85% of which were contracted when the Bank of Canada's policy rate was below 1%. And not that long ago, because the bank started to increase the overnight lending rate in 2021, resulting in an expected 22% average increase in mortgage payments for those buyers. However, the impact on delinquencies and housing supply is likely to be contained, as these borrowers were stress tested at higher rates and incomes have also risen considerably over this same time period. Politics and population growth will also play a part, as they are closely tied to economics and represent the three significant factors affecting house prices. As I mentioned before, all of these stats are available on the various social channels. I thank you for reaching the end of the podcast. My contact information will also be in the show notes. And you can reach out to me, obviously, through the various social channels. That's it for this episode of Brick by Brick, Building Wealth Through Real Estate. I will be back with a new podcast episode in a few days. Ciao, ciao.